Hi, Eric from Time to Retire here. I bought £3,000 worth of NASDAQ 3 times short this morning. Now, if you watch the financial press, you won't have missed the flurry of news around the NASDAQ and the S&P 500 teetering on the brink of collapse. Now, this news has been mainly driven by the circular trading with Nvidia buying into OpenAI, who then returned the favour by buying Nvidia chips. Not a great look, you'll admit. But will this be enough to ruffle the feathers of the tech markets? I'm not so sure. But if you want to follow along, I'm going to sell my investment of £3,000 in 14 days on the 30th of October. And what I'm going to do is every day I'm going to post a video here with an update on how my £3,000 investment's getting on and what's happening in the US markets to drive any changes. Now, the NASDAQ 3 times short is a bit of a gamble. And as a YouTuber, I do get paid to produce silly content sometimes. And as part of that, I can afford to do silly things occasionally. Now, if this was just my own investing, I would not be doing something like this. So please see this for what it is, which is entertainment and definitely not any kind of financial advice. Now, in case you don't know what the NASDAQ 3x short is, then I'll explain in the next few videos. But for now, all you need to know is that if the NASDAQ goes up by 10% in the next 2 weeks, I'll lose about £1,000. See you tomorrow. Hey guys, Eric from Time to Retire here. Yesterday, I put £3,000 into the NASDAQ 3 times short. And in 24 hours, I've made 5.6% on my investments. Just luck, you say? How very dare you? It's down to precision timing, expert knowledge, and an instinct for market changes. No, yeah, you're right. It's just pure luck. And probably sometime later today or Monday morning, things are going to flip and I'll probably be worse off than when I started. So this is day 2 of 14 because in 14 days, I'm going to cash in my investment to see how my gamble went. Now, I can tell you, I'm not hopeful really. I mean, here's the performance of the index I've invested in over the past 6 months. Grim, isn't it? There are even warnings on the investment page that holding this index for anything other than a day or two is never a good idea. So why am I doing it? Well, because I make YouTube content and I thought it'd be interesting. Now, I'm not recommending this and I'm not trying to give any financial advice here. So I would absolutely love to cash in my £142.28 profit now and use it to buy lots of tapas next week when Tracy and I have a few days in Spain. But in the interest of my YouTube channel, I'm going to leave it exactly where it is until the 30th of October. So I have one question for you. I put £3,000 in yesterday. Today I've got £3,140. In the comments below, I'd love it if you would put in your best guess of how much I will have on the 30th of October. And hopefully, good guess anyone does, we'll get a shout out on the 30th. Now, shorting or inverse position means the investment is designed to profit when the underlying asset or index goes down in value. So, for example, if the underlying index falls by 1%, then a standard inverse product would aim to gain 1%. Now, the 3x or the triple leverage part means that the fund attempts to magnify the daily returns by a factor of 3. So an example here would be that if the underlying index falls by 1%, the 3x short product aims to gain 3% or 3 times the inverse return. And of course, vice versa on that as well. So my short position is not just a gamble, it's actually a gamble on steroids. I mean, markets are closed over the weekend, so I'm not going to be able to let you know how I get on tomorrow or Sunday, but I will be back on Monday and I'll let you know how I'm getting on then. Thanks for watching. See you soon. Okay, I'm an idiot. I've lost over 10% of my investments in 24 hours of trading. Now, Friday morning, my investment was at 5.6% up. And now, as the markets open on Monday morning, I'm 4.7% down. Now, what did I do wrong? All the advice I hear is to invest in market indices. Well, I invested in the Nasdaq, an index of US companies, well, with a tilt towards tech stocks, but it's still an index. Well, 2 mistakes jump out immediately. Firstly, I bought the inverse of the market. So as the market goes up, my investment goes down. Secondly, I bought a product that uses derivatives to apply a 3 times multiplier to my investment. So when it does go down, it goes down 3 times faster. Now, of course, the inverse will be true. If the Nasdaq, my investment will go up by 3 times the amount. The only problem with that is that the Nasdaq has recently been on one of the best performance runs ever. So my little experiment is now in day 5 of 14 and over a third of the way through. Now, the experiment is to invest £3,000 in an attempt to time the market for a crash in the AI stocks.
Hey, that's a really good idea.
And that's being widely predicted. Some even give the 29th of October as the day, and I finish on the 30th. Now, timing the market, though, is really a bad idea. Nobody can predict a market rise or a market fall over a 14-day period. Now, give me a 14-year period, and I can give you the right direction in 99.9% of the time. The market will go up in the next 14 years, and I'll take a bet from anybody on here on that. 14 days, though, that's a coin flip. Let's see how I get on tomorrow, where likely I'll be in an airport. More then.
So my Nasdaq experiment took quite the hit yesterday on day 5 of 14 of my stock market crash test. I mean, Nasdaq 3 times short. It hasn't moved much this morning, but the last few trading days have been a bit of a roller coaster. So this morning, I'm in an airport about to catch a flight, but I wanted to explain what went so wrong yesterday. Why did the Nasdaq increase so much? Well, this week, tech are really delivering some results. So we got Netflix leading the charge today. And investors there are going to be looking at subscriber counts. But you've also got Coca-Cola and their report today. And this will give a bit of a read on consumer strength. Now, tomorrow, Wednesday, all eyes are going to be on Tesla. I mean, it's coming off a record quarter for deliveries, but it is facing quite a lot of questions about its lower cost models, thinner margins, competition from China. Intel also reports on Thursday, and analysts there will be watching for the recovery of the PC and the data center businesses. And they're both under pressure from AI-driven competitors like Nvidia and AMD. So, is there any good news for me this week? Well, the September CPI report hits this Friday, and it's expected to show inflation does remain stubbornly high, particularly in services. Now, economists anticipate that the headline figure will hover around 3.1% year over year. Now, the ongoing government shutdown means economic visibility is still pretty murky, really. Much of the usual labour and spending data hasn't actually been released for 3 weeks, and that makes the CPI data even more important. Now, Fed officials have signalled that another 25 basis point cut is likely if inflation cools just enough to give policymakers room. And the market seems to be pricing that in with some growing confidence. So I'll see you at the halfway point tomorrow, day 7 of 14, from some distant shore. Okay, day 7 of 14, halfway through my experiment in timing the market crash. So I've got a few different pension pots, and the one I've been using for this experiment is my 10-year SIPP, or the Freetrade SIPP, that I won't be actually accessing for at least 10 years. This means my risk appetite is a bit higher than my main pot, which I hold in Interactive Investor. And that's a pot I'll be drawing down from in the next 10 years. Now, anybody who is a member of my channel on here will know that I detail my individual investments regularly. So at the midway point through my NASDAQ 3 times short, I'm £94 down on my £3,000 investment, or just over 3% for the week. So I'm happyish overall, but there's no sign of that imminent stock market crash. See you tomorrow. So, week 1 is behind me in my 2-week experiment to time the market for a crash. Last night was the big one, the Tesla earnings call. Now, Tesla said its profit fell more than a quarter due to a trio of issues: an increased cost from US tariffs, the loss of emissions credit revenue, and also the vast expense of its pivot towards robotics and AI. All 3 of these things ate into its margins. Now, Elon Musk said its third quarter adjusted net income fell by 29% year on year to 1.8 billion, which missed the expectations of 1.9 billion. Now, investors had hoped for a boost from record vehicle sales in the quarter as consumers rushed to make purchases before the end of the US green vehicle incentive. But extra costs, including spending on AI talent, actually eroded Tesla's profits. Now, revenue did surpass the analyst estimates of 26.6 billion, rising 12% to 28.1 billion. However, its operating margin of almost halved to 5.8% from 10.8% per year. Now, this meant that Tesla shares on the announcement dipped by 3.5% in aftermarket trading. It'll actually be interesting today to see where they go when the markets do open a bit later. So for the week anyway, I'm £630 up in this portfolio, but £34 down on my NASDAQ 3X. See you tomorrow. Eric from Time to Retire here. Welcome to day 9 of 14 of my timing the market crash experiment. I mean, after some good news for me with a very poor Tesla quarterly report, I had some bad news from Intel. They did quite a bit better than the analysts expected. The share price jumped up about 7% overnight. So over the 9 days, I'm in the red by £110 on my £3,000 investment. Now, the whole premise of the experiment is based on AI creating a bubble that's due to burst. Now, of course, Intel do make computer chips, but they focus on CPUs rather than GPUs. And the GPUs are the ones that are driving the world of AI. So for an indication that an AI bubble was imminent, we'd be more looking to the likes of NVIDIA results rather than Intel. Or even Microsoft, Google, Amazon, all of whom are very heavily dependent on AI for their future growth. My portfolio for the week is up £1,100. So overall, I'm pretty happy. See you tomorrow. I'm Eric from Time to Retire. Now, I'm 9.5% down in my timing of the market crash, with only 3 days left to recover my position. Now, over the weekend, I have been thinking about the impact of index investing on the markets, and in particular, the NASDAQ, which is, after all, the index I'm betting against. Now, in a fair marketplace, the share price for companies who are overvalued based on their performance drops, and the share price increases for those that are undervalued. But passive index investing screws this up. The percentage of investments going to index funds, passive investing, has been growing rapidly. Now, passive funds account for around 29% of the total investments across the world. But in the United States, where my NASDAQ 3X short lives, passive index funds, which include index mutual funds and ETFs, have reached a significant milestone. As of August 2025, index mutual funds and ETFs accounted for
50.6%
of the total net assets in long-term mutual funds and ETFs. It's been even worse for domestic equity funds, where the index share of total assets is higher, and it's reportedly at 61.7% and rising. So the idea that the share price for overvalued companies will drop, I think, could be broken. The share price is so heavily influenced by people passively investing in the whole market. Now, my experiment is focused on the overvaluation of the Magnificent Seven. Because our index investments are market capital weighted, then every time you put £100 into a NASDAQ investment, you're putting the largest percentage of that into the Magnificent Seven, even if they're overvalued. So has the stock market been broken by too much passive index investing? Let me know in the comments, and I'll catch you up tomorrow. 2 days. 2 days left to recover my 10% loss on my experiment to time a market crash for the NASDAQ. Now, I've blamed Intel, I've blamed index investors, but it's about time we faced reality. A reality we knew all along. Timing the market is not big and it's not clever. Fortunately, my entire portfolio is made up of medium-term investments that have done really well, and I'm up about 25% over the last 6 months. And that's even when you include my failed bet on the market crash for the NASDAQ. Imagine though I'd gone heavy. I mean, as it is, I put about 1.5% of my SIPP portfolio into this experiment. So a 10% loss reflects, less than 0.2%. That's pretty much a flicker in the volatile market environment we're currently invested in. Anyway, as promised, I will be selling up on my NASDAQ 3 times short position on Thursday morning, and I will come back to you then. Unless anything dramatic happens over the next 48 hours, I'll see you Thursday morning, 30th of October. My experiment's over. Over the 2 weeks I held the NASDAQ 3 times short, my investments dropped by nearly 11%, meaning the £3,000 investment ended up at £2,673. So big shout out to Mike Todd, who predicted my investment would end up at 2,640. So really, really close. Now, the time in the experiment to end on the 30th of October wasn't random, as you probably guessed. The Federal Reserve announced a 25% basis point cut last night. And that was as the market expected, and had been priced in for months, to be honest. Now, if they hadn't cut rates, this could have been a very different ending. Now, on the same evening, we had Microsoft, Google, and Meta with quarterly results. Again, but no major deviation from market expectations there. And lastly, Trump announced an agreement on trade with China. So, although my investment did improve today by 3%, it wasn't nearly enough to reverse my losses. But hey ho, the moral of this little story is that timing the market's never a good idea. Thanks for watching.